The spread between renting and buying it blew out. It actually was pretty close between renting and buying on a pure sort of mortgage versus rent basis. The spread is unbelievably ahistoric, the result of which is that people are renting longer. And demographically, they're having fewer kids. They're getting married later. They're renting longer. They're having fewer children. So all of that spread, and so the population is indeed aging.
Hey everybody, I'm Samantha Parrinello, as you know, the host of Wealth Unfiltered. And today I have Jeff Adler, the VP of Yardi Matrix, the data division. This is the third episode of our educational series, the 2026 Multifamily Outlook. All right, everybody, thank you so much. And help me welcome to the show, Jeff Adler. Hi, Jeff. How are you today?
Doing great. Very well, Samantha.
Amazing. Well, I'm so excited to have you on. As you know, we're doing an educational series, and the first thing that everyone wants to know is why they should listen to you. So as the VP of Yardi Matrix, can you tell us how you got here and a little bit about your background?
Sure. I actually got here through somewhat of a circuitous route. My background actually is in the consumer marketing and finance. I was management consultant. Then I worked for Progressive Insurance back in the early 90s, setting up the consumer Progressive Insurance brand. I transitioned over to real estate around 2001, 2002 with Aimco, which has now been sold off to Blackstone, as the company's first risk manager. And then through a series of sort of fortuitous events, became head of marketing and then chief operating officer for the REIT, and then left right around the GFC, did a few things on my own, and then joined Yardi in 2014 to build its sort of investor data information toolkit. And I've been doing it and having a great time since then.
That's incredible. And, one thing I wanted to ask is how has Yardi become like really known as like the people to really look to for multifamily?
Well, I think the data was sort of there, and first of all, Yardi Systems acquired a little company called Pierce Eisland, which was one of the providers of market information in 2013, similar to the Axiometrics of the world, similar to a lot of companies that CoStar eventually ended up buying, similar to Reese, which Moody's ended up buying, and then I joined 6 months, a year afterwards, and really went about basically building the toolkit I wish I had when I was chief of operations for Aimco, all the things that we needed, and then just communicating that out to as many people as we possibly could, that what we have to say, and hopefully, that it was meaningful and helpful. We've been very grateful and gratified by the response we've had over the years, and having a great time and continuing to do so.
Amazing. Well, I know that our company, we obviously use CoStar, but Yardi Matrix, I'm the head director of marketing and I use you guys religiously for my data.
Well, hopefully we'll win your business. That'd be great.
Absolutely. No. And, I want to jump in. You guys have an extensive data source for multifamily. And,
Mhm.
like I mentioned, I use it all the time. So what I'd like to understand from you is you're looking at the data for 2026
Right.
and you're seeing all the trends, you're seeing what's happening in real time. Where would you characterize the current phase of multifamily cycle right now?
Well, it's actually a bit bifurcated, to be honest with you. We're still living through the aftershocks of COVID. Okay. So I think it's important to sort of set that in context. It's 5 years, God knows, even 6 years on, but we're really not all the way through. Okay. So particularly in the Sun Belt and the Mountain West. So in the Northeast and Midwest, there was still run up in rents about 30% across those markets. There really wasn't a very big supply response because there wasn't a big movement of people into those particular regions. So the Midwest is kind of normalized, and then rents are growing there 3-4%. Kind of, life just kind of goes on. You could do a value add there and everything will work just fine. In the Sun Belt, and again, I would say Mountain West, where I have Phoenix, Denver, Boise, Salt Lake City, these cities had tremendous population migration inward out of really an acceleration of 5 or 6 years worth of migration crunched into 6 to 8 months. So you had a tremendous flood of people. New rents kind of shot up like really, really high because there was suddenly a shortage of housing. Money was relatively inexpensive, and there was a construction labor available, even though it was disrupted with COVID. And there was a government policy that encouraged new supply. in all these cities. So what happened? Markets work. Now, real estate markets work. They work with a little bit of a lag. It's not like, kind of immediate, I can't make widgets, with a 3 month lag. But creating housing takes time. And so rents did go up in 2020, 2021 on new leases. Renewals kind of followed a year later. Those rents shot up in a meaningful way, 15, 20, 30%. And then new supply got authorized, got in the ground, and it's been delivering since 2024. So 2024 was the peak. 2025 was still pretty high. 2026 will also be still pretty high, and it is kind of leveling out from there. It is not dropping, as some people might have maybe hoped for or presumed. It's not dropping to an 09, 010 kind of level where you go to 100,000 units. That's not happening. And also, we also include a wide range of multifamily, like fully affordable and partially affordable, SFR, BTR, student and senior. And so, we're seeing also an increase in the mix of partially affordable and fully affordable in that total number, running around, I want to say about 450,000 on a long range basis. But that includes, honestly, about 80,000 units of fully affordable and about 30,000 units of SFR BTR. Now that's multifamily, but it's a slightly different type. So if you're talking about just, good old fashioned regular multifamily, you're talking about 325 to 350, which is kind of the long run average of new supply.
Okay.
Now that's still not enough to resolve the sort of housing shortage writ large, but it is, a decent amount of supply that in the right markets can be absorbed, through a normal household formation. And the fact of the matter, the population is not growing nearly as fast, and so we're going to be at a point of equilibrium in that 27 to 28 kind of level. That's why we think rent growth will move to a more sort of normal kind of pace in the out years.
So that has me have two questions for you. So I guess before I get into the one that I expect to be a little bit longer, when you say normal rent growth, what number are you thinking?
I think normal rent growth. I have my mentor, Terry Considine, always said, though, it doesn't always work out by specifically. Generally speaking, if you can get 1 point over inflation on rent growth, you kind of hit sort of like nirvana. Okay. Again, so I kind of view that as, if I think long run inflation is running 2.5%, and I do, then we're basically at 3.5% nationally. Now, again, some markets will be higher, some markets will be lower. And then if you have expense growth at maybe also 3%, you
Mhm.
probably can get NOI growth of 5 to 6 because of operating leverage. And at that kind of level with a 65% LTV, you're kind of gotten a decent rate of return on equity, and everything kind of works.
Okay. All right. And then so when we were talking right now, you were talking about demand. And first we
Mhm.
started with the migration. So what kind of migration trends are you seeing in 2026? Are we still seeing a heavy influx into the Sun Belt? Has that kind of stabilized and been put to a halt?
Yeah, well, it's basically back to, I was told, pre-pandemic sort of norms. So it's the same corridors of migration, same migration corridors, but the absolute volume is down quite a bit. We actually are seeing, with some of the most recent census data, there's actually a little bit of in-migration into the Midwest, which hadn't occurred forever, which is a function of reindustrialization and kind of some of the AI investments. So we are seeing, and Florida's got, it still gets it, Texas still gets it, just at a lower level than had been in the past. Remember, COVID was ahistoric. So we have to really kind of understand that that's not normal. Okay. But so if we go back to a sort of 2013 to 2019 kind of levels, cross state migration is about back to that kind of level. And it's kind of what we would expect. I do expect it had come down also because of just less migration due to home sales. Home sales, generally speaking, with the lock-in effect, there hasn't been as much homeowner migration into these markets as well.
Yeah, that's one of the things that we're seeing, is that the demand fundamentals are changing in a way where it's not just us having, the younger cohort coming in, but we're also seeing really established boomers who are deciding to downsize. They're really not interested in having a home anymore and all the
Right.
maintenance and everything
That's
that
right.
goes into that. I think we're also seeing that people are choosing, like we are really, really seeing the young people, the millennials choosing to rent over buying because at this point that, the spread
The
for
spread is massive. So I just understand the spread between renting and buying is like 25%. It's ridiculous. I have a chart on this. It blew out. It actually was pretty close between renting and buying on a pure sort of mortgage versus rent basis, all the way back to the GFC and even further back. So it's blown out. So the spread is unbelievably ahistoric. The result of which is that people are renting longer, and demographically they're having fewer kids, and so they're getting married later, they're renting longer, they're having fewer children. So all of that spread, and so the population is indeed aging. But that also has had the consequence of driving down overall turnover. Okay, so I would say when I was operating properties, we would expect a multifamily turnover rate per year of about 55%. It's running about 40-ish. Okay.
Oh, wow.
And that difference, and that's a meaningful difference, is actually keeping people in their apartments. It's enabling rents to increase on renewals. At the same time, new rents to new leases to new renters is actually declining in many of these Sunbelt markets with the new supply coming in. And so you're seeing an interesting bifurcation between what people pay on renewal and what people pay on new business, to a degree that it's basically looking like self-storage almost, which has known this a factor for forever, because the groups are different, the people are different. And normally what's happened with the aging of the renter base is that they just don't want to move. And so there's a resistance to say, well, do I really want to pick up all of my stuff? Yes, I could save some money, but the hassle associated with picking up and moving is just not worth it. So I'm gonna stay here, even though I could go on, any kind of ILS and see that the rents to new leases are lower. But so that's a really interesting development. There's some concern that it might not go on forever, and that is a concern. Now, again, that's really just in the high supply markets. In the mid Northeast and Midwest, everything's up and to the right. And what we see is a normal spread where leases to new renters are higher, significantly higher than what a renewal rent would pay. And that's what we normally see in healthy markets, is that the new customer is paying more than the in-place customer.
That makes
Uh,
sense.
and it does make sense. It basically rewards loyalty, and again, everything kind of works. But you do have these periods of dislocation, which is what is being experienced again, really in the Southeast and the Mountain West.
We had mentioned, the Sun Belt having the highest migration and obviously being the area where there was a lot of new supply coming on.
Yes.
Are there any specific markets that you can think of where, because I mean, the whole Sun Belt, for the majority, we really did see that. But are there any markets where you saw a better rate of absorption than you expected, and things kind of, it's, would say, stabilizing as far as absorption goes?
What I would say is that the smaller southern cities are actually, kind of performing better. They didn't have as big of a supply kind of boost, and
Mhm.
their cost of renting hasn't been quite as high as the larger, the ones we know about, the Charlotte, Nashville, Atlanta, markets, that Tampa, Orlando, we hear so much about. These smaller markets have absorbed things better. They didn't have as much to absorb, and they basically have gotten the overflow of people leaving the more expensive places to go to smaller ones.
When you say smaller, are you kind of talking more like tertiary right outside of
Yes.
those major?
Or even a, like Chattanooga versus a Nashville, something like that. Yeah.
Understood. Is there any specific metro where you see the greatest performance happening right now, or at least that you guys are forecasting for 2026?
Well, I have to bring up my forecast sheet. I knew that was coming. Um, so I'm looking at a forecast sheet while I'm looking at you. I mean, look, I would say there's a particular chart I wanted to reference myself towards, and that is, if we do think in most of the Sun Belt, rents are still going to be going down. Salt Lake would probably be our forecast, kind of the first to cross over the threshold and actually kind of maybe grow rents. But most of the other markets are still going to be. Now, you have some that are not going down as much, like say Nashville or Jacksonville, or I think it's even Raleigh. These markets are while rents are under pressure, they're not under severe pressure. There are other markets like Orlando, San Antonio, Phoenix, and Denver, where rents are under meaningful pressure and will continue to be under pressure throughout all of 2026. So, I mean, that's actually, and again, if I was operating in a Charlotte or Nashville, that's not bad. Okay. Remember, we're also getting increases on renewals. So you actually can, with the combination of that, and we do a thing called the blended projection, where we basically take a look at the the rents on what we project on new, and then we say, well, if you look at what we're getting on renewals, how does that change the game, right? So in 2026, the only market we think actually is like flat, zero total revenue growth is Austin. All the others are anywhere from, Phoenix might be a 0.5%, all the way up to Salt Lake being at almost 2. And then that in 2027 goes to more like 2.5 on a blended basis. And then 2028, you're at 3.5. The reason we haven't seen the kind of stress or distress that one might expect to see given this kind of new supply wave is the fact that the renewals have performed better and that those renewals are on more leases than they otherwise would have been in the past. This is provided a cushion. So yes, there are things that are going bad in terms of the debt loan maturities and the stress, but not nearly to the level that we would have seen otherwise. And I think that's an important thing to note.
Sure. I saw a thing from Yardi Matrix, and it said that the advertised rents for the first time had rebounded into a like positive, breaking a 5-month,
Right.
decline we had seen.
That's right.
Is that just nationwide average or
Nationwide.
nationwide
Yeah,
average?
yeah, it's a nationwide average, obviously, but again, the bifurcation, by markets, what that means is that the increases in the Northeast and Midwest and San Francisco to a degree, right, are basically offsetting the declines in the Sun Belt. And so it's not true as, as a statement about the entire country. It's more that the averages are, you got the tails that are averaging out to a slightly positive. Kind of says that.
You're saying a decline, and so one of the things I wanna understand is some of these markets that we're talking about that have, so much absorption, when they are you saying that they're gonna decline from where they are, or they're just still negative because they were already so low?
No, no, we're seeing we're seeing continued asking rent erosion from here
Okay.
throughout all of 2026. So no, things are gonna there's still more supply that has to get absorbed. Now remember, you still have, a fair amount of supply coming in at, not the same levels it was, but again, I think our projection for this year is something like 468,000 in total. And if I have a quick review, take a look at my spreadsheet here. We're projecting on a market rate side for 2026 something on the order of 350,000 units being delivered, and in 2027, 335,000 units of market rate and partially affordable. That's still a fair amount of supply on top of the supply has not been fully absorbed. And we also saw a drop in absorption in the fourth quarter that was non-trivial. Now, there's always a fourth quarter drop on a sequential basis, but it was worse than the prior year. So there's the overhang of what hasn't yet been absorbed, plus more stuff still coming in the same markets. So the Sun Belt, again, what we kind of say is that there's some markets that aren't nearly as bad. I think it was Nashville and Raleigh and Charlotte. There are some markets where things are going to get worse from an asking rent standpoint throughout to 2026. Again, and the part that I do kind of want to emphasize is I love these cities. They are high growth cities. They are dynamic economic centers. And over time, they will be fantastic. They're actually this process, as painful as it is actually rebuilding their overall affordability relative to other places. So it's part of a natural cycle. Quite frankly, this is just a big cycle. I've tracked this back to 1970 in terms of the waves of supply and how each of the cities have actually become stronger as they came out of that cycle in terms of rents go up, supply hits, it takes a while to get absorbed. Then the city kind of picks up again because now it's affordable relative to other cities. So we've seen this cycle before. It's just that this particular cycle, the highs were very, very high in terms of rent growth. And now the lows were very, very, kind of painful from an owner standpoint, from a consumer standpoint, not so much. So it's just that this cycle is very, high in its amplitude, but the cycle has been consistent all the way back to 1970. And this is normal for these cities. Again, I think all of these cities are dynamic. They tend to be very pro-business. They're pro-growth. They want things to happen. They also invest very heavily in their infrastructure, which is something that we also do some analysis on. And that's very important because when a city doesn't invest in its infrastructure, it runs up against suddenly its ability to absorb that population and continue that dynamism dies. And if you look back to California, you will see that at certain points in time, they stopped investing in their infrastructure. And so when they ran into a sort of an affordability issue, they couldn't continue the level of economic growth that they had prior to it. So I think that's some important things to track actually is infrastructure spending in all these cities. And they spend very aggressively in terms of building out their infrastructure. So I'm very, very bullish on these cities on a go forward basis, except for Colorado, where I live, not so much so. We can get to that later. That's more political than anything else. But if you're talking about, I look for a good public-private consensus on the desirability of growth. Then if there's a consensus on that we want growth to happen, then the public and private sectors will find creative solutions to ensure that does happen, so that population can be absorbed, so that economic growth can continue. And that's why I think many of these cities are great long term. And if you're looking to invest short term, I'd be looking for a great way in terms of basis to get in. And in that case, you're really talking about trying to find a special situation, a tax code benefit, a loan maturity, somebody who's gotten out of their skis where the bones are good, but the financial structure's a little messed up, a construction loan that's a little kind of out of whack. Those are the situations in the Sun Belt where an entry point makes sense. Or if you're doing a development deal, you can basically say, well, I won't actually put money in the ground, for until 2028. Okay, I can see that too. So it's really a timing issue where
Right.
you could go anywhere in the Midwest in most cases. And as long as you were thoughtful, you could do an acquisition today with a reasonable value add and it would all work. You don't have to wait in those markets.
And a lot of the things you're talking about, like for an operator who's looking to acquire or an investor to invest in that
Yes.
Sunbelt, really, I feel like the dynamics that you're talking about are then they need to be more conservative and more realistic on their NOI growth or on the asking rents and just
Yes.
really be a lot more conservative as far as that goes. Like I know one of the things is people usually are like, okay, 3% growth year over year starting from
Mhm.
day one. And
That
that's
doesn't
just
happen.
not reasonable. So I mean,
That's not reasonable
those
in those
fundamentals,
markets.
right?
Right. That's not reasonable in those markets. And that's where you're also looking for total revenue growth, not like 3% growth is going to come out of thin air.
Right.
Again, a lot of these assumptions are decent rules of thumb, or they were decent rules of thumb. And quite frankly, I used many of them. Okay. So I can't say that I wouldn't, but modeling now an acquisition does require a fair amount more of additional refinement, where you have to say, what's happening with new leases? How many leases are actually turning? What's happening with renewals? Which unit types are actually the ones we may even see we actually have data on the turnover rates by unit type, by bedroom bath type, and there are differences. And so modeling now requires a lot more refinement than maybe the simplifying assumptions, which were decent enough, maybe, even 5, 6 years ago. In this environment, you have to be far more refined. Particularly, essentially you're catching a falling knife, as it were. So you have to be very careful about what your tolerances are, and also that you've got enough cushion that if you're off by 100 basis points on the downside, in any given year on rents, the sky won't fall. And I think that's prudent, because as good as we awfully try to be on forecasting our rents, there is a margin of error around it. The world is inherently uncertain. So we try to get it as close as we possibly can. But anyone will tell you that they're going to nail it exactly is a fool. It's just not going to happen.
So we're talking about, underwriting and transactions. So when we look back at 2024 and 2025 were some of the lowest transaction years in
Yes.
the most recent history. When you look at this year, are you thinking that the behavior you're seeing is that we're going to start seeing more transaction volume, that the price discovery is pretty much complete? People are going to have a little bit a smaller bid ask spread. Like where do you see the transaction market?
Well, it's important for you to understand yes, there's a bid ask spread. The buyers know exactly what they're willing to pay. Okay. So that's not the issue. The issue is, if you're a seller, do you want to actually get to the point where the buyers want to transact? Okay. And as a seller, if it really depends upon what's your basis and what's your fund life, right? So anything that was bought in, I'll call it prior to COVID, okay, even if you got such a sort of built-in wealth creation activity, yes, you may not have gotten the top of the market, but if your fund life is over and you need a liquidity event, your debt was locked in prior to COVID levels, you've been paying things down, you had enough rent growth, you're going to be fine. Okay. And so those deals will transact and they will clear. That's really because the seller has a need to sell. Okay. The the ones that are interesting from a sort of a stress level is people who bought at the top of the market. They bought with variable rate debt because they were kind of pushing a little bit. And those in those places where fundamentals have eroded since 2022. Now, there's still enough equity that the lender is going to walk away just fine. And I talked to a lot of my clients who are basically buying the loans to get at the equity because they can pay pretty close to par on the debt. So it's just a question of how much the initial equity holder can hang on with their fingernails because they'd like to be, again, hoping for a turn, but many of them are just going to have run out of time. And so I do think we will see a 15 to 20% increase in transactions relative to last year. Last year was pretty low, and so it was 24. So as volume, and we are seeing that as volume kind of comes back, but it's through a combination of now we're start seeing that the largest number of loan maturities will be coming up in 28, 29, but there's a lot of maturities in 26 and 27. There's also accumulated deals that got rolled over, had extensions, and all kind of have to just, okay, it's time, you got to roll it. And so we are already seeing, I would say, and I would expect to see this trend to continue, about a 15 to 20% increase in transaction volume from this level. But it's not necessarily that there's suddenly been this emergence of, nirvana and price discovery. It's that and there's plenty of dry powder. The buyers know the strike price they want to get to.
Right.
But only if the seller determines, okay, I kind of have to live with that and I kind of have to exit. Because again, if I was a holder of a property and I didn't have to go, right, and I could hang on for another couple years, 3, 4 years, this thing would stabilize, I would if I could, but I may not be able to.
One of the other things I noticed, and I'd like to know your take on it, is, I feel like, in the last, I don't know, probably even 5 years, let's say, you could look at regionally and pretty much know, depending on if it was a Class A or B asset, your cap rate would be here at X, Y, or Z. I kind of feel like what's transpiring is that it's going almost metro to metro. It's becoming a lot more significant to specific fundamentals happening in that
Right.
marketplace. Are you seeing that trend as well as far as how cap rates are going there?
Well, because a lot of it is based upon the trajectory of where rents are, right? And that does differ by metro. Because so remember, cap rate is a convenient shorthand for what the actual financial modeling is. And
Mhm.
there's an old joke that I would go to investment committee and someone would say, well, what's the cap rate on the deal? And I would jokingly say, what do you want it to be? Because then I can make the number whatever it happens to be. So I view cap rates more as the result of a sort of underwriting calculation, not so much as a number that I go to at the beginning. Okay. And that's why you're going to see more metro to metro variation because the trajectory of revenue performance, right, varies to a greater degree metro by metro. And so really you're modeling out that trajectory of revenue as well as to a certain extent expenses are, quite frankly, 2.5-ish%. They're kind of back to some level of normalization. There's still a need to cut expenses in order to sort of cushion the revenue decline. But that's why I do think that you are seeing much more variation, particularly, again, I would say particularly in the Sun Belt, right?
Okay.
Again, if I go to the Midwest, rents are 3.5% growth. I know what roughly my debt structure is, my debt cost. I know what my exit cap rate's likely to be. So I can make that work. And there's more uniformity across that because the market conditions are more uniform. Where market conditions are more variant or divergent, you're going to see cap rate being more divergent as a result of the modeling, not because the number is different out of thin air.
You spoke about modeling, and it seems like you have a lot of experience with that. Is there some at this point where you're seeing maybe there's like 3 factors that are like the most important at this point since cap rates is definitely, such a
Yeah.
variable?
Right. The fundamental, kind of numbers are, okay, what is in fact the risk-free rate? And if you're going to, if you're talking about long-term debt, it's probably 4.5. You put 150 basis points on that, you're taking out a 5.5 in terms of long-term debt. You could bring that down if you go 5 years, maybe 50 basis points. So, okay, so let's say your debt is 5 to 5.5% with a decent execution, not necessarily super high risk. All right. So what's your revenue projection, right? And then what's your NOI projection and expense projection, right? So if my exit cap rate is probably going to be again around 5.5, right? I look at my sort of NOI projection, and then I back into like, well, what is my entry cap rate? If my cap rate has to be 5-ish, 5.5-ish, I need some level of revenue growth to get to the kind of IRR I expect given a 5.5% exit cap rate, which is not unreasonable given the time. So then it becomes literally is a modeling exercise. How do I get, I know this endpoint. I know what my target IRR is. I know what the beginning is. What's the price that I have to basically solve for that gets to the number that I'd like to be at? So that really is the exercise one goes through. It's not, it's shrouded in mystery, but it's actually not that complex.
I love that. Well, I think that's helpful too, because we have listeners who are all the way up to, family offices, but we also have a lot of novice investors who are
Mhm.
trying to reevaluate what's going on in their portfolios and understand the growth cycle and what's going on, just everything going
Right.
on right now, especially when the underwriting seemed very on. And then all of a sudden, these economic fundamentals have just shifted, with
Yeah.
everything that's happened. So I think it's helpful for people to go back to that initial underwriting and have some ways to evaluate that and maybe differently than, oh, here's my cap rate.
Right. Well, I do think also, I mean, this is something maybe I'm more of a macro investor as well, is I do like to look at what are the forces shaping, the economy, what are demographics look like and the aging of the population and the housing stock and I'll call it deglobalization. And those things I think set a context for then you can then say, okay, in the context here, what's going on in how does this region fit into the rest of the context? And how is it basically growing? If you're a real estate investor, particularly as you're a multifamily investor, you would like to see some level of dynamism in the economy, right? Or you want to at least make sure that isn't going horribly wrong and that you have a little bit of population growth, a little bit of a migration, and not a lot of new supply. So that way, the demographics, which is the aging of the population, will lead to more demand, right? So you don't necessarily need population growth; you just need no population decline. Okay, and the aging of the population and the cost of homes basically leads you to an increase in effective demand, which is why the Northeast and Midwest are doing well, right?
Right.
Their population isn't exploding, but the other factors at play are kind of helping them out.
That
Okay.
makes sense.
Now,
Yeah.
I don't think single family home prices will crash in the South. And I track this also, not that I'm not an expert in single family, but it's important that I understand single family because the housing market kind of is a sliding scale where people move back and forth. We are seeing again, in the Southeast and Mountain West, declines in home values of 8 to 10%, which is important because it improves affordability some. You can't drop single family home prices. Otherwise, you're going to have a banking crisis. In order to improve affordability, you need to bleed that thing out over some period of time, and it needs to bleed out. And you need some income growth, and it would be helpful if you had a little bit of help on the interest rates, not a lot, and that's how things kind of get a little bit better. And I am seeing that, which is why there is the probability that well, first of all, I do not think that turnover will go down any further in multifamily. I think there's a possibility that it could tick up a few points in the coming year or two, as some people kind of at the margin kind of move into homeownership. I also think, as an aside, that single family built to rent communities are a great alternative asset class
Right.
because essentially they provide the space of a single family home or something near to it, and the feel of one without having someone to tie up their capital, right? It's a tweener. It's right now it's a kind of a small niche. It's most effectively built at the rim of major cities, particularly in the Sun Belt. It's really not populated by people with school age children because the school district's not very established. It's mostly empty nesters, somebody with a pet, somebody who doesn't have to come into the office 5 days a week and wants a little more space, and is at the age that like a flat, an apartment doesn't quite fit the need.
Right.
But the movement to a home either is a little scary, or remember, you still have to save 20% down, right, on a home at an elevated price point. That's a lot of money,
Yeah.
and you can get the lifestyle. If you have an income, you can make the payment. You just can't get the down pay, and that works for people. So I'm very excited about that particular segment. I know it's a little off
No, I
topic,
love it.
but I like that segment quite a bit. The rents do move with multifamily rents. We've
Okay.
tracked this very, very, very clearly, and it kind of you get more space, but the rent per square foot is a close to 2 bedrooms in sort of mainline suburbs, right? But basically you're further out and you're getting more square footage, but you're paying about the same rent per square foot.
I love that. Yeah. Well, okay, so you touched on interest rates for a second, and that's
Mhm.
something that I find very interesting. There in my opinion, I think that people maybe correlate too much to what's going on as far as interest rates and the weight that they give it for multifamily. But I'd like to
Mhm.
know from your perspective, how sensitive do you think multifamily performance is to Fed policy and overall interest rate?
Well, there is a relationship, and I also look at the money supply, as well, right? And generalized. The real core is what's inflation, and then the rates follow from inflation. So if I look at the growth in the money supply and inflation, we're back to a place after the COVID run up of you're something. The money supply growth is growing. It is so you're not having money supply contraction. The money supply is growing again, and inflation is in that, I'll call it 2.5 to 3% range. The activities that are going on between on the curve, the short versus long end of the curve, there's definitely a impact of how the government is financing itself. Now we can't quite forget as we get into interest rates, there's inflation, there's also how the US government gets financed. Okay. And the guys running the show, both in terms of Besant and the new Warsh, the new Fed chair, they very much understand that high debt to the debt to GDP at 120 or debt to U.S. government revenues of about 600% are about as high as that can go. So something's got to this can't go on. Okay, now if you understand that can't go on, and what can't go on generally doesn't go on. And so the longer rate issue is the federal deficit of 1.6 to 1.8 trillion is primarily driven by entitlements. My biggest concern, I'm going to go off a little off topic, Samantha, but I hope you'll forgive me. The biggest concern I have is socially anyway, is the divide between younger and older Americans.
Mhm.
If I look at the core issue, who has benefited the most from the run up in inflation? People who held assets. Same way as in the 30s, by the way. Who benefited? People who held assets. Who do people hold assets? Older Americans.
Yeah.
Now, the difference between the 30s and today is, in addition to that, benefiting from the run up in assets, who's the biggest beneficiary of all the entitlement programs? Older Americans. So it's not surprising to see this sort of growth in political polarization be most acute among the young, right? Both left and right, is because they are seeing the system not work in their favor generationally,
Mhm.
which, and in 2033, Social Security has to get dealt with because by law, benefits will be cut by 27%. It is not feasible for that to happen to lower income Americans who are elderly. It's going to have to happen to higher income Americans.
Mhm.
And by the way, I knew this 40 years ago because when I was in my senior year in college, my professor told me flat out that the Social Security system would not work for any higher income Americans in 40 years. So I've known this my entire working life.
Yeah.
It's not a surprise.
Right.
That issue has to be resolved. But the consequence on the short term, I swear I'll get this back to interest
No,
rates.
it's okay.
The consequence of that is the US government has to juggle its terms in order to get the interest rate low enough. So what it's been basically, if you listen to the Fed policy, they have said they're not going to buy CMB RMBS mortgages, and they're not going to increase their balance sheet much. But what they're going to use is that extra capacity to buy short-term treasuries to reduce short-term treasury rates so that the federal government can roll over its debt short-term and not have to pay long-term rates so it can finance the deficit.
Right.
All right. So I mean, like and the Fed basically wrote it out. It's not a surprise. You have to pay attention. Okay. Which is what we would expect to see is that, so there we expect to see a sort of a steepening of the yield curve because the Federal Reserve is by design attempting to move short-term rates down and is willing to let short-term rates go up a tad. Obviously not that much because then you blow out everything else.
Right.
Right. But anywhere between 4 and 4.5, the Fed's not going to worry too much. Okay. Now, I would highlight back what does that mean for real estate investors?
Yeah.
It means is yes, you probably can finance short. Okay. for a time and take the benefit of that spread if your whole period is shorter, because I don't think we're going to see a spike in short-term rates. Okay. There's more of a concern on the long-term rates because that's inflation. And when things start to go bad with federal government debt financing, they go really bad on the long end of the curve. Okay. But again, it's basically in check kind of right now. So if you're going to go for a short term, that would be kind of okay. You could save yourself 100 basis points. That might make a deal work. Be having a 5-year term versus for taking a 10-year kind of term at a higher rate. So that's that notion of how you would play the yield curve. I do think, again, I'll give you a little history lesson. Go back to look at 1946 to 1952. There was a formal agreement between the Treasury and the Federal Reserve to control the entire yield curve, like the Bank of Japan has done, in order to delever the federal government. We're going to see that again. In fact, Bessent and Warsh have admitted as much, that they intend to coordinate, once Warsh is in the seat, on a program that will essentially bring interest rates below the rate of inflation for people who are savers. So investing in bonds, investing in your savings account is probably not going to be the best use of your money. Putting it into some portion of hard assets, we've seen the run up in gold and silver and copper. Some notion of hard assets is probably going to be a better play in this environment, which is not disinflationary. Okay. It's neutral to inflationary. And so you have to change your playbook. Everything up until 2020, from 1982-ish to 2020, we were in a deflationary trend. Right. That trend is over. We're either stable or up for demographic reasons and government debt reasons. Until there's a resolution of Social Security and entitlements and Medicare, you're not going to see that pressure decline. So who cares, right? Well, what do you do with that?
Great.
You basically say, if I want to invest on a 5-year term basis, okay, you'll take that benefit. You want to lock it over a 10-year period of time. I don't think you're going to see long-term rates come down much. Now, we've seen a little bit of bouncing, right? Over the last couple of days with the Iran situation, where it went down below 4, but then it popped back up. I think we're kind of, I'll call it range bound between 4 and 4.5 on the 10-year. And then you can take that and move that forward.
Sure. With everything you're talking about, what you really made me think about okay, so we're looking at the macroeconomic environment. We're looking at all these key fundamentals for multifamily. So when you take into full account of the big picture, the overall picture, when you look at 2026, what do you think maybe is some of the biggest risks that investors aren't looking at yet?
Well, there's a political risk that is non-trivial in certain places.
Okay.
So that's another one of these bifurcations, right? So we have a bifurcation in market fundamentals. We have a bifurcation in political risk. If you're going to invest in a market which has some notion of political risk, think Seattle as an example, think New York, think Chicago even, make sure you're being compensated for the risk you're taking. Now, all right. So, and that really is the city of, as opposed to the metro area of. Suburban Seattle is very different than the city of Seattle. Suburban Chicago, very different than the city, right? So I'll call it the burbs around New York, very different than the city of New York itself. And then inside New York City itself is a bifurcation between rent stabilized, which is a cluster, and sort of free market at the very high end, which is still, actually rents are growing, quite nicely there, and demand's there. So there's a bifurcation on the political risk side, which is non-trivial. You also should see when it goes the other way. Like, they had a new mayor in San Francisco who's kind of normal, and San Francisco, along with AI, right, and that is coming nicely, including the Bay Area. That's coming back nicely, but it's just come back from its pre-COVID kind of lows. So it's not like it's busted out entirely. So I think the political risk is something one has to take note of. I think the supply risk is fairly well understood. I think the economy will re-accelerate as we go through this year. There's a lot of tax benefits, both investment and consumer spending, that is going to start hitting come April, May. And so I think the economy will re-accelerate through the late spring and into the fall. Okay. And that will be kind of a upside surprise because everyone's kind of, freaking out, and there's a lot of negativity. But remember, markets increase on the wall of worry. And to my mind, this actually is not a bad thing, because the worry creates the mismatch between expectations, which are low, and reality, which is not that bad. And when that happens, markets tend to rise and
Right.
to resolve that disconnect. And so I also have a background in the public securities market. So public and private markets kind of are influenced in a certain regard. So when I look at that, I don't really see too many problems, right? I see a lot of positives. AI, for all the fear associated with it, and some of it is valid, is also enormously positive when it comes to productivity increases. And we are seeing the beginning of reacceleration in productivity growth from a 1-ish% to maybe a 2.5. And that does make a difference. Now, on the positive side, what that means is people who have a job and who have skills are going to be more valuable.
Right.
Younger Americans are going to have to acquire the skills in the use of AI in order to be valuable. The number of entry level positions where you kind of walked in and said, I don't know anything, train me, there's going to be fewer of them. Not that they're gone, but I can see it in the hiring plans of everyone I know, including ourselves. We're just not hiring as many entry level positions unless they can help us with some kind of AI skill, automate a process, perform and improve a level of productivity. That's a good thing for the economy. It's a good thing for rent growth. Eventually, it will be a good thing for job growth because people will get retooled in a way that make them more productive. That's a good thing. That's also what the United States does exceptionally well as an economy. We are very, very flexible as a labor market. And that flexibility, while it has certain, I'll call it localized disruptions, ends up creating a tremendous amount of wealth. And that flows into all sectors of the economy and also enables housing and households to occur. And our business is about the creation of households.
Yes.
That's what we run our world on, right? So we want people to have higher levels of income generation because then they're more likely to form new households. And that's what we're looking for. So again, I think you're seeing a short-term level of disruption. I think that dissipates over the next several months, and we're going to see a more, kind of positive level of trajectory. I'm cautiously optimistic, but I am also grounded in reality, which is 2026 as a multifamily operator, depending upon where you are, could be just another year of slogging it out. So what do you do in a slog? Yeah, you hang on to people, make sure they don't leave, right? Because you don't want to turn the apartment. You don't want to get a lower rent. You don't want the cost. You don't want the vacancy. Hang on to the people you got. That means a better experience for them and a reason to stay. You're going to have to continue to drive efficiencies and run and get expenses out of the system as you possibly can. And then you're competing as effectively as you need to for the number of new leases you have to fill. And then you're basically hanging on. And that's probably going to be, depending on the market, which we lay it in our forecasts, all of 26. And in some markets, all of Austin's probably all of 27 before it kind of normalizes. You'll see more markets in 27 kind of come out of this with a few markets still lagging, but it won't be the main story. The story in 27 will shift to, how things are on the upswing. And that'll happen around mid-year 2027, with the exception of a few markets, which will still be kind of in a funk, for an additional kind of 12 months before that turns around. So I'm fairly optimistic as we kind of go forward, but I absolutely am grounded in reality. And we've had to, I was at NMHC back in January, and we were bursting a lot of bubbles back then in January, just saying, look, guys, I love you all, but you need to see 26 in a clear-eyed fashion.
Yeah.
And I think the rest of the industry over the last month, quite frankly, has kind of moved to where we were, come early January.
I love it. So, I'm going to wrap it up with one last question because where I feel like you really helped me get to is understanding the reality of where we are. So in everything that you think about and everything that you're seeing, where do you think there might be one area for opportunity, whether it's a market, whether it's some specific asset class? Is there one area where you see real opportunity for 2026 for investors?
Well, I really do think that there are great value add opportunities in the Midwest and in some of these emerging nodes where you can, where the gaps, there aren't a lot of A's. The gaps are easily $150, $200 between a low B and an A. You can get a decent, something with a washer and dryer in it that's not obsolete. Those opportunities are absolutely there. And you don't have to sort of go too far afield from the value add playbook. and you can kind of you know what when the loans are coming due, you know when someone's gotta make a decision. I think those are going to be more the middle of the fairway transactions that are easy to do. Stress entry points are always problematic because you know that there's an issue, but actually how it gets resolved is yet to be determined, right? Maybe there's going to be a cash in refi. Maybe there's going to be a capital call. You don't exactly know how it's going to work out. If you can get them to happen, they're amazing. But it's a low odds kind of game where if you're just shooting for, I just want something that I know I can execute on, right? Then I could pick something. I happen to like the Midwest. Other people might like the Northeast a tad. I'm less enamored with that. I can tell you I'm not very enamored with the Denver market because I see both economic problems and political problems happening. So I'm much less keen on the Denver market. But but I would say that's what I would say is that there's definitely opportunity in this environment as long as you know that you've got to separate out your risks. Someone who wants to basically go all in on LA, okay, just make sure you get a super great price. And I do know some folks who are going into LA, but they're really going at it and getting an incredible basis because, and they're willing to accept the risk. And as long as they've communicated to their investors, we could do well or we could get entirely wiped out.
Right.
Right. And as long as everyone's clear eyed going in, again, that's not necessarily a bad strategy either. The thing I love, and as we wrap up here, one thing I love about multifamily and also love about real estate is there's a million different ways to be successful. There's not just one way. And that's what's so exciting about this business because it builds around everybody's specific and unique competency that they can execute upon. And so, and quite frankly, one organization that's competent in one area doesn't really compete with another organization that's competent in another area. And so it actually enables quite a bit of collaboration. And the last piece I would highlight is there are some amazing programs where communities are trying to preserve future affordability, like by giving tax breaks today. And so this is in Texas, this is in the Carolinas. So it's an interesting strategy. Also, I've seen some transactions even executed in the state of Washington, where in order to preserve affordability, right? So it's not a binding constraint at the moment, but it says, okay, in the future, we don't want you to grow rents greater than AMI, call it 3-4%, and we'll give you a tax break today to compensate you for the future increases you might not get in the future. Again, another interesting strategy. It's not the only one. It may not be your organization's one, right? But it is an interesting kind of niche that some organizations have a particular skill set that they want to go execute on. So anyway, thank you, Samantha. I hope that was helpful. And it's been a wonderful conversation.
No, thank you so much. So I want to thank you so much for taking your time with me today. And thank you to all my listeners and join us for the next one. Thanks so much.
Thank you. Bye-bye.